Now, I don't think that my guest, Zach Prince, is going to need much of an introduction, given how BlockFi's uh, uh, creation of its 6.2% compound interest deposit account dominated the news cycle for a couple of weeks. In fact, given the fact that the company brought in over $35 million since the product went live, BlockFi may have even maintained its dominance in the crypto mind space if it wasn't for the SEC breaking crypto's winner yesterday with the issuance of its first no action letter and the long-awaited clear and plain guidance for an investment contract framework. But with all of that said, please give me a moment to properly introduce Zach. Zach's experience includes leadership roles at multiple successful tech companies. Initially in ad tech, where he was part of two successful acquisitions, AdMeld, which was acquired by Google, and Sociomantic, which was acquired by dunnhumby. Prior to starting BlockFi, he led business development teams at Orchard Platform, a broker-dealer, and RAA in the online lending sector, and Zibby, an online consumer lender. He graduated cum laude from Texas State University with a BA in international business and a minor in Spanish. So welcome, Zach.
Yeah, thanks for having me.
It's a pleasure. Now, I asked Zach to join us today for several reasons. Aside from the obvious, which is that he runs one of the most discussed crypto startups in the industry, BlockFi's business model and trajectory touch on some critical debates and issues pertinent to the future of our industry. Therefore, today's session is going to cover not only what BlockFi is doing, but we're also going to get Zach's opinion on some of these key debates. As far as today's agenda goes, Zach is going to kick things off by giving us a more detailed brief on BlockFi than you typically get online or in podcasts, and it's going to provide a great overview of the company's product line, its regulatory strategy, and technological underpinnings. Once Zach is finished, I'm going to ask him some questions before I open the floor to everybody in the audience. Now, in order to eliminate any sort of ambient noise, I have muted everyone's microphones. But if you'd like me to ask Zach a question on your behalf, please use the chat function on Zoom or send me a direct message via Slack or email. And with that, once again, Zach, welcome, and the floor is yours. Let me just pull up your presentation.
Yeah, thanks so much for the introduction, Stephen, and I'm excited to be here. I was thinking when Steve and I were chatting before that it would be helpful to share just a few slides on BlockFi from a recent overview presentation that we made, because I think they help to highlight a little bit how we think about our long-term opportunity and what the kind of underlying business strategy is, which is a lot bigger than some of the two products that we've had in market to date. So we really think of what we're doing as modern banking. So from a business strategy perspective, the business model that we're pursuing is that of a retail bank that's crypto first. If we could go to the next slide, Stephen. Can I control the slides or?
I think you can. Let me see if I can pass off control to you.
It's okay.
I'll just follow your cues. Why don't you just go ahead and I'll just take your lead.
Go to the next one. So a quick background on the company. So on the bottom here, there's our fundraising milestones, and on the top, some milestones just in terms of product progress, leading from when we founded the company in August of 2017 to today. At a high level, last year for us was about bringing our first product to market. And our first product was the ability to borrow USD, so to get a loan secured by your crypto. We were one of the first companies to have that product in market, and we were the first company to raise institutional funding to support that product. So last year we brought that to market. We raised 60 rounds of $60 million in capital. Just under 10 of that was equity, and 50 million was a committed loan purchasing facility from Galaxy Digital. And we grew our team. We launched the product. We, given the market conditions, kicked the tires on our risk management system quite a few times, and it worked as expected. And so our performance in lending USD has been flawless. So we've had no late payments, no defaults, and no unhappy customers. And so that was really exciting. And then at the beginning of this year, we launched our second product, which is the ability to earn interest on crypto. And the idea for launching that product actually stemmed from some activity that we conducted last year. So in August of last year, or August, September, we were one side of the first ever crypto FX swap. So we lent crypto to an institutional borrower. They collateralized it with USD, and we governed the transaction with a ISDA CSA type agreement. That to us was, kind of the first time that it ever happened in the crypto world. That experience led us down the path of exploring institutional demand to borrow crypto. And as we realized that that was a large and growing market with a lot of use cases beyond just wanting to put on a short position, we decided that it made sense to launch our second product, which was the interest account. If we could go to the next slide. And since we launched the interest account, the growth has been pretty phenomenal. So the interest account simply is the ability for someone to open an account with BlockFi, deposit their Bitcoin or Ether, and earn interest on that deposit in Bitcoin or Ether, paid out monthly and compounding after it's paid out. So we launched that product in a beta the last week of January. It remained in beta throughout February, and during that period of time, we received around 11 million in deposits. And then we launched it publicly the first week of March, March 5th. And since that launch, we've onboarded an incremental 7,000 new clients and just over 50 million in assets. If we could go to the next slide. In terms of what we're going after, and we'll look a bit more at this on the next slide, which gives an overview of the products that we're planning on building. But we think that from a near-term perspective, our addressable market is crypto investors. We're starting there. But given that US dollars are now on the blockchain in a very kind of reputable construct with stable coins like GUSD, USDC, TrueUSD, and others, we think that these debt and credit and financial services products that we're creating on blockchain rails have the opportunity to be disruptive beyond crypto. So while for the foreseeable future, call it the next 6 to 12 months, we'll primarily be operating in this crypto-first environment, longer term, we think that our opportunity is to disrupt traditional banking and also to enable retail around the world to borrow dollars, which is a very large market for governments and corporations, but something that has never been accessible to retail individuals before. And now that we have crypto assets like Bitcoin and others, you can, as a lender in New York, take custody, perfect your security interest, and make an underwriting decision and lend dollars to someone anywhere in the world, albeit not a place that's on a sanctions list. If we could go to the next slide. Let's go one more slide. So in terms of our roadmap, this is a visualization, a little bit of where we are today, how things work, and what we anticipate building in the future. So on the bottom half of this slide are the products that we are delivering to the retail market. And we think of retail as being our core client. And in order to deliver these products to retail, we need to have institutional connectivity and institutional support. So right now we have US dollar loans, we have the interest account, and those products are supported by credit facilities, both traditional and swap. They're supported by BlockFi lending crypto to institutions, and they're supported by our access to the futures market. In the future, we anticipate launching the ability to buy and sell crypto. And we plan on launching two things in the card space. One, a prepaid card as a loan funding option, and two, a traditional credit card where we plan on swapping Bitcoin in as the rewards currency. So instead of airline miles, or normal cash back, you could earn 1.5% cash back in Bitcoin. And then further out, we anticipate doing a couple of things in terms of data products. One is we expect to be a contributor or the creator of a Bitcoin rate curve. And the second is that we think there will be an opportunity to contribute data to international credit scoring agencies and or create a credit score for individuals in markets where there's not a strong credit scoring system. And those products will be supported by order streaming from market makers in terms of liquidity for the buy and sell functionality, and bank partnerships for the facilitation of the card products. If we go to the next slide. Okay, keep going. I actually won't, we have 3 slides that talk about the details from a pricing and structural perspective of each one of our current products, which are the crypto collateralized loans, so the USD loans, the interest account, and then also crypto lending to institutions. I won't talk through each one of those, but if it's helpful and anyone wants more detail on them, we can go back to them and talk through it.
Hey, Zach.
Yeah, go ahead.
I actually think that some of our attendees would appreciate it if you could spend maybe 30 seconds on each one, because obviously it's critical to the future profitability of your business. So I'm sure they're curious as to the thought behind the way that you've approached each one of these offerings.
Okay, sure. So this first slide is detail on our US dollar loans that are collateralized by crypto. So we've originated a little over 11 million in USD principal since we started lending in January of 2018. The IRR on that portfolio is around 12.5%. The portfolio has never had a late payment or a default or a loss. Average loan size just over 50K. The initial interest rate ranges from 4.5 to 11.2%. And there's also an origination fee. So right now what we actually do is we have 3 pricing options for a new borrower that correspond to different loan to value ratios. So at a 50% loan to value ratio, the interest rate is 11.2%. At a 35% initial loan to value ratio, the interest rate is 7.9. And at a 20% initial loan to value ratio, the interest rate is 4.5. And then for each one of those price tiers, we have an origination fee of 1 to 2%, lower origination fees for larger loan sizes, and higher origination fees for smaller loan sizes. And the reason you see the difference in interest rate pricing based on the loan to value ratio is because we're able to generate incremental yield by rehypothecating and relending a portion of the assets that are posted as collateral. Currently, we accept 4 different crypto assets as collateral: Bitcoin, Ether, Litecoin, and Zcash. And in terms of how we make money in this product, it's all interest income. And we fund these loans one of 2 ways currently, either by selling them to the loan purchasing facility with Galaxy, or we can fund them in some cases entirely from USD that we generate by rehypothecating the collateral that was posted for the loan. Next. The BlockFi interest account. So if you are an individual that owns Bitcoin or Ether, you can go to our website and read about and access the BlockFi interest account. This was designed to function similar to a savings account at a bank in terms of having a variable interest rate, in terms of receiving interest payments every month, and in terms of interest payments becoming part of your balance and your balance earning interest in subsequent months, so it's compounding interest. This product has been live, as I said earlier, since the last week of January in beta, and publicly since the first week of March. Currently, our average deposit balance is around 60,000. We think of this product long term as being a large driver of customer acquisition, and we target a customer acquisition cost of less than 1% of the deposit size. Currently, we're offering a 6% rate on deposits up to 25 Bitcoin or up to 500 Ether, and a 2% rate thereafter. There's an important term restriction on withdrawals in this account, which maps to a term in the crypto lending side of our operation, which is that we currently reserve up to 7 days to process withdrawals from the interest account. And the reason for that is because that matches our maximum callback period from our crypto lending agreements, which we'll look at on the next slide. And our revenue model for the interest account is that over time, we expect to be somewhere between 50 and we expect to have a positive interest margin of somewhere between 50 and 150 bips in terms of the difference between the interest rate that we're paying to depositors and the interest rate that we're receiving when we're lending out crypto. So if we can flip to the next slide. So those first two products are available to retail. We also have some corporates that are using both of those products. So in terms of how we generate the interest that we're paying to depositors for the BlockFi interest account, that's all done by lending crypto to institutional borrowers. We decided to focus initially on traditional financial institutions, primarily market makers and proprietary trading firms who have large businesses in traditional markets but are starting to participate in the crypto market as our first core segment of crypto borrowers. We generally have a minimum first transaction size of 100 Bitcoin or 2,500 Ether with these counterparties. We are governing these relationships primarily with a ISDA framework that we adapted a little bit to work for crypto. And interest rates range from 3 to 8% currently. If you look at last year, this has changed quite a bit. So interest rates when we're lending crypto are variable and driven a lot by the futures market. So we expect that in times where crypto market sentiment is bearish, interest rates to borrow crypto will be higher. And in times where market sentiment is bullish, interest rates to borrow crypto will be lower. So if you look at like Q4 of last year, for example, when we were lending crypto, we were oftentimes doing it at rates north of 8%. But currently, our interest rate range is 3 to 8%. I think the weighted average rate on our crypto lending portfolio now is around 4.5%. And we typically receive collateral in either USD or stablecoin that is above the value of the crypto that we're lending. And then our risk management system that's been operational for managing risk on the USD lending side of things is also what we're leveraging to manage risk when we're over collateralized by USD on the crypto lending side of things. So that system monitors prices 24/7, issues margin calls, and also can trade if needed. So that's the crypto lending side. We can go to the next slide. This is our leadership team. So we're currently 26 people, 15 here in the US, and then 10 remote developers across Poland and Argentina. My co-founder, Flory, was previously at Bond Street, which was acquired by Goldman Sachs, and before that at Oak Hill Advisors. Our chief risk officer was previously a managing director under the prime brokerage side of Bank of America Merrill Lynch. Our CTO was the CTO of one of the first enterprise production blockchains, Factum, and prior to that, he was a VP of technology and R&D at a large publicly traded technology provider of network products. Our chief compliance officer, David Spack, was formerly the chief compliance officer at Funding Circle, and our VP of finance was a CFO at a hedge fund, and prior to that, an analyst at ESL. Next. Couple slides on risk management and technology. So we have a proprietary technology platform that we built entirely in-house. On the left-hand slide there, that's a screenshot of it. There's a couple core functions currently. The first is being able to onboard customers and manage KYC, AML approvals. And the second is risk management. So, on the back end, that's one of the dashboard views that we have for both of those functions. Next. This is just a visualization of the workflow of our margin call for USD lending. So basically our system 24/7 is running this operation. And currently the settings on that are that at a 55% LTV, we start issuing notifications to our customers. At a 70% LTV, we have a margin call. The way the margin call works is that it's a 72-hour window where the USD borrower can either add more crypto, pay down the loan, or take no action. If they take no action and after 72 hours, the crypto price has not recovered, our system will liquidate enough crypto to bring their loan to value ratio back down to 50%. And if during that 72-hour window, the price of crypto falls further and their loan to value ratio hits 80%, our system will automatically liquidate enough collateral to bring their LTV back down to 70. Next slide. In terms of compliance and regulations, so there's three primary buckets that today we've operated under. The first is state level lending licenses. So we're currently authorized to lend in 44 states. We hold lending licenses in 15 states now. And we are in the process of applying for money transmission licenses in addition to the lending licenses, because we'll need those to offer the buy and sell functionality that we anticipate launching in Q3. We were, as far as we know, the first company to kind of take a position on where Bitcoin should fit within the Uniform Commercial Code. We filed our first UCC1 in January of 2018. And then lastly, we're currently registered with FinCEN as a financial institution to file SARS, and we will be updating that FinCEN registration to a full MSB registration. That's actually a process that we've already started and that is ongoing, and we expect to be completed in Q2. Yeah, I'll pause there.
Okay, thanks, Zach. That was really helpful, and appreciate the detail you went to on some of those products. Very illustrative for our members. And just so everyone knows that may or may not have been fervently screen saving throughout the presentation, this Zach was kind enough to allow me to distribute this to all of you once the session is over. So we'll make sure that it gets out to everybody from there. At this point, Zach, I have some questions that I'm going to ask you run you through for about 15 or 20 minutes, and then I'm going to hand it over to the audience for questions. So everyone, please consider what we were just walked through, and feel free to send me questions over chat or Slack or email, as I said before. But Zach, my first question is, right now you only really handle a handful of assets. I was wondering if you could provide a little context on how you decide which assets you want to support or not support. And as a corollary to that, how may or may not will the SEC guidance that came out yesterday impact your thought process along these lines?
Yeah, so we decided early on that, from the beginning, that we did not want to build functionality on our end to securely store crypto assets, and that was something that we wanted to partner on. We decided to partner with Gemini for the secure storage of crypto assets. So we've used them since day one and continue to have a great relationship and leverage their platform for the secure storage of all the crypto assets that we touch. So one of the first things that goes into our consideration set is just whether or not something is supported on Gemini. The second thing is just addressable market size. So anything we do, we'll likely do with at least Bitcoin and Ether. And then the last is customer demand. So, are we hearing from the market that this is something, that there's support for our products and demand for different crypto assets. Whether or not the SEC guidance from yesterday has any impact on us, um, not really. We, as a result of only working with assets so far that are on Gemini, we feel pretty confident that we aren't, we wouldn't be touching anything that's a security, and we have no plans to issue a utility or security token in the near future. So it's actually not it's not something that we follow too closely. I
Okay.
mean, we read about it obviously, but for our business, there's not really too much of an impact there.
Yeah, how could you? At this point, I don't think any of us could have avoided it, even if we wanted to. Uh, Next question. I would imagine that a great deal of your originations come directly from the website, but it's difficult to scale this in the long term. And I know that you're looking to partner with other banks and exchanges as distribution channels. Uh, without mentioning any names that you don't want to, can you contextualize those discussions a little bit? I mean, what are the real benefits that these counterparties see, especially on the bank side? What are their biggest concerns?
Sure. So we do anticipate having partnerships with banks. We currently have relationships with 4 banks for, just general like banking services and money movement. We will also be partnering with a bank to support the card products that we want to launch. Um, in terms of those partnerships for distribution of our products, we think of the target market for that as being other crypto market participants. So, for example, wallets, potentially exchanges, especially exchanges outside the U.S. market. And then there's a couple of other areas. Actually, the first one that we targeted was crypto tax software. So we have partnerships with Zen Ledger and Token Tax and a few of the other leaders in the crypto tax software reporting market. And right now, those partnerships are primarily just marketing related. So we'll have some information about the partner on our site. They'll have some information about us. There'll be a mutual link sharing that occurs. But in the future, we want to deliver an experience that is analogous to like point of sale financing. So think about when you're on a retailer's website and you go to check out, and there might be an option to check out with Amazon or to finance the purchase using a firm. And if you click on one of those buttons, a new experience pops up, and you're able to interact with that third party, but you haven't left the retailer's website. And we envision a similar type of workflow and a similar type of user experience, except in the crypto world, it would be something like, you go to your crypto wallet of choice. There's a button in there that's powered by BlockFi that would enable you to either borrow against the crypto that you have stored in that wallet, or move that crypto into an account with BlockFi to earn interest on it. And you would click the button, a BlockFi experience would pop up, but you would never actually leave that wallet environment that you're already used to interacting with. So that's how we think about partnerships. And we should have the first, kind of larger ones going live towards the end of this quarter or early Q3.
Interesting. I mean, it sounds like you're making a lot more progress than even a lot of traditional fintech startups are with certain elements of partnering with banks. So that's great to see. And I would also, I know this is something that is a little bit further down on your roadmap, but as part of these discussions, are you looking to also help leverage some of their credit risk scoring models? Because I would imagine that the first group of customers that come to you are ones that are a self-selected group of very responsible individuals that want to see your product succeed. But at some point, as you're looking to scale up and out, you're going to have to make some more difficult decisions when it comes to who to extend credit to and not.
Yeah, I mean, when we're lending USD, over collateralized by crypto, we're not particularly concerned with the credit quality of the individual from a FICO scoring or ability to repay perspective. We do check things like whether they have a history of bankruptcy, or whether they've been convicted of any financial crimes in the past. We're certainly doing a lot of KYC and AML checks. But where we will use and what we will potentially partner and look to leverage credit scoring infrastructure that a banking partner may have is when we launch that Bitcoin rewards credit card. And we are extending credit in the more traditional unsecured sense of the word. But for the lending USD secured by crypto side, we don't need to do too much traditional credit scoring type work.
Okay, and perhaps even just the point of convergence between those two lines of business. I'm sure you saw the news about the recent Atomic Capital offering, where they're issuing loans with an LTV of 85%, which is higher than what you are comfortable with doing right now. So, I guess my question there is, what are your thoughts on that, and how do you really determine what your comfort level is for LTVs?
Yeah, great question. From a regulatory perspective, there's not anything that would prevent us from lending at a 90% LTV against a crypto asset that's a commodity. There are existing companies, for example, AMark, who just did a $70 million securitization where they're lending against precious metals at 90% initial loan to value ratios. So we think that from a regulatory perspective, that's something that we could do. The reason we have not done that to date isn't necessarily because it would carry more risk to BlockFi. Our risk management system would work if we lent at an initial 75 or 85 or 90% LTV, but we don't think it would be a very good customer experience. So when we decided and built our risk model, we kind of optimized around a couple of things. The first was the frequency of expected margin calls and collateral liquidations, and we wanted that to be below 5%. And the second was the amount of time that we felt that we would be able to extend to our customers in a scenario where they hit a margin call. And there was also a consideration on our end of, not wanting to lend at a level that would, raise eyebrows. When we applied for lending licenses starting in 2017, the crypto market was in a very different place than it is now. So we wanted to be reasonably conservative, and we felt like it made sense at the time, at least, to not lend at a ratio that would be higher than an analogy from the securities market, even though these are not securities. In terms of what I think about atomic loans specifically, I'm scratching my head a bit on what regulatory framework they are using. It sounded like atomic loans was the front end for customer acquisition, and they've got a partner that's actually going to custody and manage the risk. And that maybe that partner has the equivalent of a broker-dealer license in Europe. I'm not aware of a way that you could make consumer loans in the United States without lending licenses in certain states. So a bit of a head scratcher on that side, and we'll see. They're brand new. I don't think they've made any loans yet, so we'll see.
Okay. What are your thoughts on centrally bank issued digital currencies, and how may they impact your business model should they come to fruition?
Oh man, that is a really interesting question. I think that one of the macro themes that we will see play out over the coming 5 to 20 years will be currency consolidation. A theme that we've already seen over the last 50 years is the concentration of power around the dollar. I think that concentration of power around the dollar theme will continue. I think that Bitcoin in particular has a chance at gaining market share during the currency consolidation phase that I think we might enter. In terms of central bank issued currencies, I think it's just a matter of time. I think it will absolutely happen. I don't think it will eliminate the need for cash. I think it will be interesting to see, which countries go first. I think the U.S. will be one of the latest and possibly never participate because in the U.S. We have this kind of system that's designed to enable a banking sector to thrive. And central bank issued currency could have dramatically negative implications for the banking business model. But I think it will happen. I think it's much more likely that China goes first versus the U.S. And I think you'll see much smaller countries be the actual first movers. And I think it's really powerful. I think one of the things that doesn't get talked about in terms of what any digital currency, whether it's central bank issued or not, can enable is an increased velocity of money. There was a study done in the UK like a year and a half ago that asked the question of what would happen if the pound was issued on a blockchain, and they estimated that the velocity of money would increase and that that would have a positive impact on the British GDP to the tune of 1 to 2% growth in the first year. So I think that velocity of money thing is real. I think there's no reason that we shouldn't be able to move money and transact on the weekends and Sunday at 3 a.m. And simply by enabling that, we can create some growth in the global economy.
Okay, great. Do you have a dedicated policy on things like airdrops and forks?
We passed through Gemini.
Is it more for Gemini?
Yeah, we passed through Gemini's policy to our retail clients. And in terms of how we govern airdrops and forks when we're lending crypto, we use the CME terms.
Okay. Before I take questions from everybody joining in, I just have a few other big picture type questions that I wanted to get your thoughts on.
Sure.
I mean, for one, I'm interested in your perspective on the long-term utility of crypto assets, because as a global advocacy organization, that's something very near and dear to us. As you mentioned, right now, most of your borrowers are either individuals that are long on crypto and are seeking instant liquidity to pay bills, make an expenditure, go on a trip, or institutions and proprietary trading shops looking for additional leverage or to facilitate market making activities. Do you think that these are some of the primary long-term uses that you're going to be funding, or what is your long-term perspective on sort of what the crypto economy is going to look like if successful 5, 10, 15 years from now? Hello?
Hey,
Hello?
sorry. I muted myself to cough, and you had to unmute me, so it took me a second.
Okay. I thought there was an IT problem. Go ahead.
So I think that that Bitcoin will be at a minimum digital gold for millennials, and I think that at a maximum it will be a participant in that consolidation of currencies globally, and I think that other things that we will see are a reduction of costs for a lot of components of financial services, including remittance, including cross-border payments, and potentially including credit. The thing that I get most excited about, regardless of what crypto asset we're talking about, is this theme of accessibility. And for me, accessibility kind of has two prongs to it. The first is accessibility to a traditional fiat system that works well. I was fortunate to travel a lot growing up, and it always struck me as odd that someone born in a country with a bad monetary system and a bad government was so disadvantaged relative to someone born in a developed country with a strong monetary system. And I think that cryptocurrency in general has a chance to level that playing field a bit. And then I think there's another angle of accessibility as it relates to investments. So, whether that's security tokens or something else, I'm kind of like a personal finance junkie, and I used to have a fintech blog, and there's this podcast that I listen to called Animal Spirits, where it's like a wealth management podcast, and they take listener questions, and recently they had a listener question, and it was someone from Colombia, and the question was basically, I'm a young professional, I have enough money to start making some investments, but I really only have access to the Colombian stock market, and there's 20 publicly traded stocks here, and none of them are really that interesting for me to invest in. What do you think I should do? And the response from the host on the show was kind of like, we have no idea. That sucks. And that doesn't really make sense to me. I think that investment access globally can be a lot better than it is today, especially when you're talking about retail. And I think that the crypto market in general will help facilitate that.
Okay, that's great. And finally, I kind of mentioned to you earlier in the week, but we can't have a discussion about lending and credit in the blockchain space without mentioning rehypothecation. As you know, Caitlin Long is a good friend of the WSBA, and we had the privilege of having her sit down for a fireside chat with our CEO, Ron Caranta, a couple of weeks ago. And I think her perspectives on the space are relatively well known. Certainly yours are a bit different, and you see this, I mean, from one, not only as necessary to building a profitable business, but also, as we discussed, I think it's also really relevant for creating a modern economy. Credit and liquidity is an important part of that. So I was really just hoping to see if you could expand on some of those thoughts. I know you published an op-ed, I think it was a week or two ago in the Block, and it was carried in a few other publications. So I know you have some interesting thoughts on that, and I'd love it if you could share your perspective.
Yeah, sure. I mean, definitely check out the op-ed. I think the Block and a few other publications put up a shorter version of it than the one that we have on our blog. So, feel free to check that out on BlockFi.com. But
and we'll send that out to everybody too when we circulate the PowerPoint and everything else.
Yeah, cool. I mean, I think at the highest level, the way that we think about it is that a market with more options is better than a market with less options. And that if part of what Bitcoin and other cryptocurrencies need to do to be successful and continue growing is compete with the traditional financial system, that it's going to be really hard for them to do that if market participants don't have the same tools that the traditional financial ecosystem does. I think that, on Twitter and in other places, the kind of perceived differences between Caitlin Long's view and ours can be, kind of like heightened above what I think they are in reality. So, if you read like the Forbes op-ed that Caitlin has, where she talks about good lending and bad lending, in terms of Bitcoin, BlockFi actually falls into the good lending camp, because when we're lending crypto, we're moving it physically and we're generally getting it over collateralized by US dollars. There was a bit of a, I guess, boogeyman that was caused by us putting the term rehypothecation and BlockFi having a right to rehypothecate in our terms and conditions for the interest account, which frankly we did out of an abundance of caution approach. I'm not even sure if that's the right term to describe what we're doing in the interest account. It might be repledge or some other legal term. But at the end of the day, we think it's better to have that option. We think that rehypothecation in traditional markets is not as bad as Caitlin may make it out to seem at times. We think it's a critical component of a functioning market. We think it's a critical component to enabling strong liquidity and strong price discovery. And we think it's good for Bitcoin.
Okay, Great. Starting to get a few questions in from the audience. First one, are you at all concerned that, for one, that banks and as banks and other fintech startups such as Square become more comfortable holding crypto and offering trading in crypto, that they may end up encroaching on your business model and beating you to scale?
Yeah, absolutely. I mean, our opportunity at BlockFi is to grow fast enough, diversify our product suite fast enough, and make clients on our platform happy enough, such that when Square and others inevitably start offering similar products to BlockFi, we're able to compete with them. And along the way, there may or may not be an opportunity for us to combine forces with one of those platforms, which is something that we'll consider along the way. But it's financial services. Financial services are hyper competitive. They're in general commoditized. We think that the way that you build a successful business, especially as it relates to retail and financial services, is by creating a sticky relationship with your clients, which you do in two ways. One, by delivering a fantastic experience, and two, by offering multiple client can use to create a level of stickiness. So it'll be a question of how successful we are at going as fast as we want to go, and the time frame for those other companies inevitably coming our direction.
Okay. Someone's asking for a little additional context and insight into your international strategy. How do you typically choose which markets you want to enter? And Latin America in particular is interesting just because of the fact that there's several distressed economies that seem to make perfect sense for crypto, but at the same time, governments are already cracking down on people involved in the ecosystem. So I guess this depends on which countries you're looking to enter, but what is your strategy on sort of getting the market penetration necessary without running afoul of authorities?
Sure, good question, and it kind of depends on the market. We have not had a huge focus on international market penetration to date. We do believe that long term, it will be a core component to our strategy as we grow. But right now, 95% of our client base is in the United States. We have started to form our international strategy based on just activity that we have seen to date. And there's been kind of two interesting trends there. One is that from an interest account perspective, we've seen a lot of demand or a general trend of demand from places that have a negative yield environment. So, primarily developed economies, in particular Japan so far. And then conversely, when we're lending USD, we've seen more demand from less developed economies, and specifically LATAM. In terms of that, in terms of regulation, our current plan is to take a kind of two-tiered approach. In Japan, for example, we've already identified counsel. We already have a bit of a regulatory compliance roadmap. But in LATAM, our current strategy is to take a bit more of a Uber-esque approach of forgiveness, not permission. And that may change over time, but that's our plan now. And the fact that there are tokenized, reputable tokenized dollars on the blockchain now is really interesting when you think about delivering financial services that are dollar denominated to emerging and frontier markets. And it'll be interesting to see what happens from a regulatory perspective in terms of the U.S. reaction and the reaction from regulators in those markets when financial service companies like BlockFi become more active in terms of marketing our products and services there.
Okay, great. Can you elaborate some on the tax and accounting partnerships that you mentioned earlier in the discussion, and sort of expand a bit on what they might look like in the future?
Sure. So to date, it's primarily been marketing related in kind of two areas. So one is that we have created a lot of content that you know is attempting to educate people on how cryptocurrency is treated under U.S. tax law. A lot of that content has been cross-published on crypto tax software companies' websites, and we have you know co-marketing relationships with a couple of them. Where, for example, when BlockFi sends out a newsletter about the April 15th tax deadline and links to some of those articles that we created, we're also mentioning that ZenLedger and Token Tax are two of the leading crypto tax software providers. And if you're struggling with, figuring out how you're going to classify, report, and just get the data for your crypto